So traders, today is actually August 24th, 2015, and we're experiencing what I think is a monumentally impactful and important day in the markets. A lot of fascinating things going on right now, and the fascination is in regards to just the magnificent move in the market. So the Dow is down at this moment in time, 563 points. It was down 800 points just a few moments ago. So we've had 300 point swing, and the market's only been open for 20 minutes. So it is really a sensational kind of move. And think or swim, actually, I think their servers have crashed at this moment. There's so much order and data going on, and it's going to be a little bit hard to find some day trade. Well, let me rephrase. It's not hard to find any day trades. It's going to be a little difficult, just semi-difficult to find a good trade with a good risk reward that looks like it might roll over bearish. And we'll see if we can find any bullish trades out there. We're going to keep an eye on a few things. But I had a trader ask a really good question. My goal was to make this video actually, honestly, this week anyway. So I figured let's just do both. Let's help out some students who are here live in the morning floor at Real Life Trading, and also those who want to check this out on the recording. There's a lot of people here. This is a packed house right now, so might as well just do this, and I'm sure it'll help somebody. That's the good news. So what I'm going over today is I'm going to go over broker orders. Broker orders in regards to really just the different types that are out there, what they mean. There are potential abbreviations. Now, obviously, every broker is going to have it potentially a little different, just a little different. So I'm going to just do my best to and this might be very beneficial to a lot of you, but honestly, some brokers might be so different depending on, if you're an international student, it could be really, really different. So, just make sure that you like your broker, number one. Number two, you can always call them. Okay, if you have any questions, you can always call your broker. Remember, they work for you, right? You pay them. They work for you. So make sure you like them, and if you ever have any questions, call them, ask them, see if they can help out. But what I'm going to do is let's go over it really quick, and let's just look at a general stock, Facebook. The reason I'm looking at Facebook is because Brad just gave me numbers. But look at the size of this candle, my friends. This candle is it is from $72 to $80. This is an $8 move. This is a 10% swing in Facebook in a matter of minutes. Market's only been open 21 minutes. So there's a lot of volatility today, and volatility is great. Volatility is very, very fun to trade, but we're just going to be a little bit patient on it right now. So let me go ahead and break down the orders that are out there. First and foremost, we have the most simplistic order that happens. You have the market order. Okay? You have the market order, and you can have a market order to buy something, or you have a market order to sell something. Anytime you buy at market, you're going to be buying at what's called the ask price. Anytime you sell something, you're going to be selling it at what's called the bid. The bid and the ask are really important to remember, because it doesn't matter what instrument you are trading, if it's an option or if it's an equity, you will always be buying at the ask and you will be selling at the bid. And your ask right now on Facebook, meaning if you were to buy Facebook today, at this exact moment in time, is $80.56. The bid is $80. Well, it just moved on us, but it was lower than that. So you can see how this is moving. But let's just say the bid was, that's how volatile the market is. In 20 seconds, it moved 20 cents. Let's say the bid was $8.50. Okay? So the ask is $80.56. The bid is $80.50. So if you do a market order and you just instantaneously buy the stock, you're going to be buying at $80.56. You have a 6-cent difference. So you're automatically losing 6 cents per share that you buy. You're automatically in the hole. So that's important to know, because, if you're doing a large portion, or if you're day trading or even swing trading, it's just beneficial to know what, the bid and the ask, because you want to understand, obviously, you want to buy as low as possible. Same thing with the sell. So if you're going bullish on the stock, you buy at the ask at $80.56. If you're going bearish, you sell at the bid at $80.50. So if you sell at the bid, Then the ask is $80.56, and now you have also the same thing. You have a 6-cent loss per share because you bought at $80.50. Now, in the middle of these two numbers, okay, is what's commonly referred to as the bid-ask spread. And this is how the markets make money. This is how the market makers and the exchanges make money. Specifically the market makers, from the bid-ask spread. So the bid and the ask and the spread, you have 6 cents in here, right, that you can negotiate. So think about, literally it is a market. Markets are negotiating. You can negotiate with the market at what price you want to buy something. The most common order is what's known as the most common order other than the market order, in my opinion, is known as a limit order. A limit order allows you to differentiate and distinguish specifically at which price you want to buy or sell something. So if you want to buy Facebook at, let's just say, $80, and that's the price that you want to pay for it, if you did an $80 limit, okay, so you have market and you have limit. The limit at $80 allows you to buy at $80. So if Facebook ever gets to $80 or lower, then you can buy those shares at $80 or lower. So as an example, on Facebook, Friday it closes at, what's the exact close? Closes at $86.06. So let's say, for example, you said to yourself, man, there's a really, really good support at $80.74. I want to buy Monday morning or whenever if Facebook gets down to $80.74. So $80.74, stock comes down. I want to buy at that price. I'm going to do a limit buy on Facebook at $80.74. So if Facebook trades down to $80.74, then you'll buy it. So the open this morning on Facebook was $77.03. So students from around the world, if you did an $80.74 limit on Facebook on Friday, at what price would you have been filled this morning? You would have been filled at $77.03. You would have been filled at the open this morning of Facebook. That means, yes, you'd already be up $3 a share. And the reason I'm saying that is because if you did an $80.74 limit, you're literally saying to the market, all right, I want to buy at $80.74 or better. Whatever price you can get me in better than $80.74. So again, if the market opened at $77.03, then it's below $80.74, so that order would get filled. Same thing as if you did a limit buy at $72.76. Which is another support line. So just randomly, let's say you did that, a limit buy at $72.76. Well, the low of today was 72 on Facebook. So that means that if Facebook traded down to the support, you would have gotten filled in at $72.76, and then Facebook bounced very, very quickly. So you may or may not have gotten filled, but if Facebook was below $72.76, that would have been your order. If you want an order to stay out there for a very, very long time, the abbreviation GTC stands for good till canceled, which is semi-grammatically incorrect. It kind of should say good until canceled. But I guess it's just kind of like a cool abbreviation. Good till canceled. Woo-wee, man, this order is good till canceled. Till it. Good till. Good until canceled. So if you did again, this is one of, I read an article recently that this is a fun way to deal with market corrections. Is if you think a market's going to correct or pull back, you just set some outrageous good till cancel buy orders in there and just set it and forget it. If you are a value investor or you like stock, you're in it from the long term, or maybe you're a younger investor and you just want to buy the dips, good till cancel can be fun. Because a good till cancel, you just set the trade up and you just kind of forget about it. So if you ever get the pullback, so like for example, on Facebook, if you did a good till cancel limit buy at $80, you would have gotten filled this morning for $77. Now, in some brokers, good till canceled doesn't necessarily mean forever. As Maria just wrote in, some good till canceled is only good for 6 months, which is still a pretty long time. But when I said good until canceled, literally means this order will be open unless you actually go in and cancel that order. Unless you go in and cancel it, which is not very hard to do. So that's market and that's limit. Now, there is a limit buy. So let's just, I'm going to go into an intraday level on Facebook just to kind of go through this for just a moment. This is a 5-minute chart. And earlier, Brad threw out some numbers for us on Facebook, which really doesn't look that horrendous. 79, I think 79.58. What's the low of this candle? Low of this candle is 79.60. All right, so let me go to trigger. Give me 1 second, and we're going to explain this as we're looking at it. Again, you can see the volatility here on Facebook is quite massive. So I'm trying to format this. So this is 79.58, which is below the white candle. So notice the low of this big bullish candle. So if you're ever trying to take a trade bearish, you want to get below. You want to get below the low of big bullish candles. So here's a big bullish candle, and here's a big bullish candle. Other than that, there's really not that much between these levels. The low of this candle is 79.60, so you want to get below that price. And if you're trading, it doesn't matter if this is a day trade or a swing trade, truly. But the stop in this level, he said, would be 81.92 is the stop that he's looking at. 81.92. So this is when we're going to be wrong on the trade. This is when we want to exit. So the high is 81.90 and 81.88. So the stop is above the actual swing high, the pivot high, the resistance on the daily chart. So we mentioned a limit buy. There is also something called a limit sell. So limit buy, again, is just simply you telling the market at what price you want to buy something. That's all you're saying. What price do I want to buy something? So if this is a limit buy down here, right, you're telling the market, okay, I want the stock to pull down to 72.76, so you do a limit buy at 72.76. And if the stock is at 72.76 or lower, you will buy there. Simple as that. If you do a limit buy, it'll fill if the stock is below 72.76. Now, a limit sell, so some people just have a hard time thinking about limit sells because they don't understand specifically how stocks go, how you make money when a market goes down. But don't worry about that right now. Just think about selling something like you're selling a house or a car. Okay, these are things that we've all tried to sell at some point in time, or a baseball card. You want to sell as high as possible. It doesn't matter what you're selling. Okay? If you're selling your car, you're selling your house, or you're selling your Tim Tebow autographed football from college, you are trying to sell that thing as much as you possibly can. Why? Because you want to make as much money as you can. I hope this makes sense. So when you're selling something, you want as much as you possibly can get when you sell. So a limit sell, you're trying to sell at a high value. Okay, this is when you're trying to sell your shares. Now, what's interesting is you could be selling your shares for a profit, or you could be selling your shares to try to get into a bearish position. Let's just say, for example, you did this trade today. Now, I don't know anyone who did personally, and I also did not do this trade, but let's just, as an example, say that you did. Let's say you did a limit buy this morning at 72.76. And it was a trade that you had good till canceled, and you had that trade open for 3 months. And it finally filled today. Limit buy 72.76. So you bought down here, okay? You got an alert in your email at work that your Facebook order filled. So you're like, wait, Facebook order filled. Man, this is great. Obviously, you're in the South or something. Okay? So the limit buy filled, and now you're in the shares, and now you're saying to yourself, okay, I want to lock in a profit. So you hop over here and you do a limit sell at 81.92, just as an example. $81.92. That means if Facebook gets above $81.92 or higher, your order will sell at $81.92 or higher. That's it. So you're selling, you're getting a profit because you bought low, you're selling high. So you do a limit sell at $81.92. If and when Facebook is above $81.92, then it will sell at that price, whatever the price is. So let's say, for example, Facebook never gets to $81.92 all day, does this all day, and then tomorrow it opens at $90 a share. Well, if Facebook opened at $90 a share and you had a limit sell at $81.92, you would actually sell your position at $90. You would sell it up top. And that's what happens, and that's what causes retests a lot of the times. When I talk about retest gaps, is if you have a lot of buying, a big bullish candle, a lot of people are buying, they're going to set a limit sell a little bit higher for a profit. So if the stock comes up here and gaps, okay, their limit sells get filled and the stock starts trading down a little bit because they're selling. They're selling high. So your Facebook order would have just filled, right? 81, stock is above 81.92. So if you had that limit sell at 81.92, you'd have gotten filled in, from your previous limit buy. Now, let's say that you don't have the stock. Okay, this is where people get a little bit confused because, again, I just explained if you have the stock and you do a limit buy, you're buying it, then you can do a limit sell to sell it. What if you don't have the stock and you want to make money as the stock is going down? Well, if you click that link right there that I will put in for my people watching it in the recording, you'll hop over to the video that explains short selling. If you want just a little bit of an idea of what short selling is and how to actually make the money when the stock is going down. If there is at any point where you are trading a stock and you're saying to yourself, I don't know, let's just go use Skechers, for example. Ticker symbol SKX. Let's use Skechers and say you wanted to short sell Skechers at, I don't know. Let's say you wanted to short sell Skechers at 158. So the stock was going up, and you remember the old adage, buy low, sell high, but you were smart enough to kind of flip it around a little bit, and you thought to yourself, sell high, buy low. Okay, remember, sell something as high as possible, buy it for as low as you possibly can. So you could do a limit sell if you don't own the shares for whatever price that you want. So let's say on Skechers, you did a limit sell for $160. That means that if, so I'll type that in, limit sell. Sell high, buy low. Limit sell at 160, you will only sell the Skechers stock at 160 or higher. If you do not have the shares, this means that you are selling short. This means you're bearish. You want the stock to go down. So a limit sell to 160 gets filled, and right now you can buy to close. Okay, let's say at $130 limit, buy. So here's a limit buy. So this is a literal and exact replica of limit sell at 160, limit buy at 130, and you're just flipping it around. So you sell high, buy low, you made $30 per share profit in this example. Again, I didn't personally do this trade. I did not sell short the stock at Skechers at 160. Because there's a lot of times when you're looking at a trade, you want something that people refer to, or a lot of traders refer to as confirmation. So you don't just try to pick the top and the bottom. You say, if the stock does this, then I will do this. Those are often referred to as what's called trigger orders. So notice how you'll see this little word trigger intraday on a lot of my charts. That means that this is the price at which I will actually trigger into the trade. So I'm not in the trade yet, but if the trade does, whatever I want it to do, then I'm going to get triggered in. So let's look at Skechers, then I'll hop over. Actually, let me go look at Sprouts Farmers Market. Brad's giving me a trade on Sprouts Farmers. So notice right here, this was a trade that we had set up, and this is this is a trade, okay, that we did. trigger intraday limit sell at 20.55. So notice Sprouts Farmers Market was going sideways for about a week and a half, and then when the stock went below 20.55, I have a trigger that says trigger intraday limit sell. What does that mean exactly? Well, that means that at that particular price, not before, not after, but at that price, I want to get in bearish on the stock. I want to make money as it's going down. So you would do what's referred to as a stop order. Now notice this says stop right here. There are two different types of stops, believe it or not. Well, maybe even three. There's a stop when you are not in the trade. Not in the trade. So you're not in at all. Okay? And then there's a stop where you are in the trade. Are in the trade. So you have two types of stops. You have one where you're not in and one where you are in. So if you are not in a trade, you can set up a stop order to trigger you in to a trade. So in this example on Sprouts Farmers Market, the trigger intraday limit sell order at 20.55, you were saying I am not in the trade yet. So I'm going to do a stop at what price? What price, ladies and gentlemen? What would you do a stop at? 20.55. You would do a stop at 20.55. Now, what would you do? Well, if you are bearish, you would do a stop, 20.55, and then you would hit the sell button on your broker. You do the sell button on your broker because you're going to get in bearish. You're trying to make money as the stock goes down. So you do a stop sell. So this would be a stop. Remember the other two terms I just gave you? There's a stop market and there's a stop limit. So the stop market at 20.55. Remember, when you're doing a trade, there are really only two types of trades that you can do when you're getting into a trade. You can either do a stop market or a stop limit if you are not in the trade and you want to trigger in. So you have market and you have limit. And you have stop market and you have stop limit. Stop market triggers you into the trade. It executes the trade at a price that you create. So for example, if you are not in the trade, notice this is green colored for you. You do a stop market at 20.55. Then you hit the sell button because you're trying to get in bearish. Simple as that. Do a stop market and you put in the price at what price you want to go bearish on the shares themselves. So when Sprouts Farmers Market went below 20.55, the order triggered. It didn't trigger before or after. It didn't trigger before. It only triggered when Sprouts Farmers Market was below 20.55. This is the easiest way to do it. And if you do a stop market and you click the sell button and you type in the price at which you want to sell, you're going to be selling at whatever the bid price is at market. So if the price is 20.53 and 20.56 and 20.53 is the bid, you will sell your shares at 20.53. Your trigger is 20.55. And hopefully you make some money on the trade down. Your target to exit the trade would be, since you were bearish, would be a buy limit order. Because you want to buy at 16.81 or lower because you're bearish. Since you're bearish, that's how you exit the trade. You buy to cover. The red stop that you see on my screen at $22.42, once you are in the trade, so you have the other type of stop. Stop. You are in the trade. Okay, so once you are actually in the trade, now you go ahead and set your stop at 22.42. This would also be stop market, but you would buy in this area because you are getting out of the trade. You are exiting the trade for a loss. That's when you were wrong. So if Sprouts Farmers Market had done this, trade up 22.42, I would have been wrong on the trade. I would have lost approximately $2 on that stock, $2 a share, and I would have gotten out. So the stop would have been a stop market. The target would have been the target where I buy at a limit price. So again, when you buy at a limit, you want to buy at 1681 or lower. Sell high, buy low. In this example, if you got triggered into the trade and you wanted to do a stop and a target at the same time, you would still have to fill out the order forms. You would do a buy limit at 1681. You would do a buy stop market order. So you literally would type in the stop market order at $22.42. And then you could create what's commonly referred to as an OCO order trade in most brokers. This stands for order cancels other. So what that means is if either one of these trades gets hit, if you fill at 1681 or if you fill at 22.42, the other trade gets canceled for you. Simple as that. So now you're done with the trade. Now you don't have any other quote unquote obligation outstanding. You're more or less done. You're out of the trade. Everything is finished. If you hit your target, your stop is now canceled. And the reason that's important is because if you are bullish on a trade, it's just the exact opposite. You can have a buy stop market, and if you do not have the position, this would be triggering you into the trade. Because remember, a stop, you have two types of stops. You have a stop that you are in a trade and a stop that you're not in the trade. If you're not in a trade and you set up a stop market order, that is the price in which you would like to trigger into the trade. Bullish. So let me go on to Sprouts Farmers Market. This is a swing trade that has already played out to its entirety in 2 days, which is kind of radical. Pretty cool. So let me come in here to the 5-minute chart on Sprouts Farmers Market. And where's my little drawing? Okay, it's kind of strange. It was right there. It just didn't show up. So I'm coming into the 5-minute chart on Sprouts Farmers Market. And we're looking at this pennant pattern that's shaping up. And what we're going to do is we're going to take Brad Reed's numbers that he posted into the chat pane, and we're going to see if we can day trade this guy and see what happens. So Brad says, I like Sprouts Farmers Market, 1858. I'll do 1855. And again, this is for let's say 1898. So here's the two prices. So if this is an intraday limit sell, we'd come in here, we'd format, and we could literally say trigger intraday stop market order. And this would also be a stop market order. Now, as of right now, we're not in this trade. This is a trade that we are not in. So if you set this trade up as a stop market order, but you're buying, that means this would be a trade that this would be the trigger at which price you would buy Sprouts Farmers Market. That is a stop buy market order. So again, all this does, this is the button that you press in the broker. Hopefully you realize that. You press that button. You press the buy or you press the sell. This is just simply telling the broker what you want to do. So I want to stop at 1898, and at market, I want to buy this position. This trigger, if it's bearish, same exact thing, would be a stop market order to sell if you're bearish. Stop market. Boop. So if it triggers down there at 1855, you would sell the stock at 1855 at the bid, and you would now be in the trade bearish. Once you're in the trade bearish, you could set your stop buy market order at 1898, because if you're in the trade bearish, this is how you get out of the trade, is you buy. And then your target down here would be also a buy limit. Okay, so again, you want to sell high, buy low. So now this is where some people get confused, but remember, you have market and you have limit. So I think we've covered what a market order does, right? You can either just simply buy it at the market. So you just go in and buy or sell at the market price. Whatever the market's trading, boom, get me in. You can have a trigger to execute at a particular price if you want. Whatever that trigger is, doesn't matter. So as soon as the stock hits that price, the trigger will execute. You can also do a stop limit. So remember, there's stop market and then there's stop limit. This is where most people get confused, which is good. That means you guys are about to learn something. Stop limit, ladies and gentlemen, is two orders. You have the stop and you have the limit. You have stop and you have limit. Your stop is the price at which you want the trade to trigger. You want something to happen. You want the stop to do something. I wish, honestly, that they could go in and change the word from stop to trigger. A lot of people would, depending on a broker, it could be a little bit easier, depending on how you have everything set up. That's really what the term, stop kind of confuses some people because they think it's a bad thing, but it's not. Stops are good. All stops are good. All stops are good. So this word stop, think about a stop sign. If you say the word stop enough, it sounds kind of strange. Stop, stop, stop. It's kind of a weird word. It spells pots backwards. Believe it or not, and I'm almost not even exaggerating, most of the time I see stop, I see pots. I have my brain just takes words and just blah, 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 jumbles them all together. But anyway, a stop limit is two separate orders. You have a stop and you have a limit. So the stop would be, ladies and gentlemen, $18.98. That's the price at which you want the trade to trigger and do something. What do you want it to do? That's up to you. I don't know. This would be a stop. And what you want it to do, you want it to buy. That's what you want it to do. How do you want it to be bought? Do you want to be bought at market or do you want it to be bought at limit? That's what you have to tell the market. That's what you have to tell the New York Stock Exchange. What do you want? You have your trigger at $18.98. You have, what do you want to do? I want to buy. How do you want to buy? Limit. So this means if Sprouts Farmers Market traded up to $18.98 and you wanted to be bullish, meaning you want to make money as the stock goes up, and you did a stop limit buy order at $18.98, as soon as the stock went to $18.98, the New York Stock Exchange or whatever route you have it going through would say, all right, guys, Joe Smith here wants to buy some shares of Sprouts Farmers Market at $18.98. Let's start trying to process that order for him. But he has a very specific price in here that he only wants to pay $18.98 or less. So he wants to buy it. So now that the stock has moved above $18.98, he wants to buy this stock. This order is live, ladies and gentlemen. Joe wants these orders. And he wants them badly. He wants the shares. But he wants them at $18.98 or less. So if the stock does this, goes up to here, boop, and just keeps going up, never turns back, Joe never had the chance to buy at $18.98 or less. As soon as it hit $18.98, stock can go to $18.98, then $18.99, then $19, then $19.01, and just keep climbing and climbing and climbing. It never has to go down. That's why I don't use stop limit orders when I'm trying to get out of a trade. Because if I'm trying to get out of a trade, if I'm wrong, I do not want to be wrong and this happen. Okay, I don't want to just totally miss my stop. So when I'm trying to get out of a trade, meaning when I'm trying to get out, if I am wrong, or if the trade is no longer moving in the direction that I intend to move it in, I do a stop market order. I do stop limit orders to get into a trade. I do stop limits to get into a trade. So again, here it is. This is what I refer to as a bracket trade. Not what there's a lot of other people out there refer to this as a bracket trade, but this could be, I want to go bullish here and I want to go bearish here. So if the stock does this, I'm bullish. If the stock does this, I'm bearish. So you could do a stop limit and you want to buy the trade at $18.98. So that's the trigger, and you only want to pay $18.98 for that particular for those shares. If you do a sell stop limit, the stop is $18.55. This is the price at which the trade will get triggered into you live. That means the order is open and you want in. And your limit, you can make the limit price whatever you want it to make. You can do it whatever you want. But if you do a limit of the same price as your stop, that helps reduce dramatically what's referred to as slippage. And slippage is simply getting filled at a price that you did not want to get filled at. So if you do a sell stop and you do it at market, whatever the market is trading at, you can get filled for. So if the stock has a crazy bid-ask spread like they did this morning, right, and you want to get filled at $18.55, but in fact you get filled at $18.40, well, that's 15 cents difference. It's a big deal. Okay, so stop limit, a stop simply says to the market, hey guys, I want in on this trade. Get me in. And a limit simply says at what price you want in at. So $18.55, if you do a stop, that is your stop, and then you have to fill in the limit. That is two separate orders. You have to fill in a stop, and you have to fill in the limit for both a buy and or a sell. This, ladies and gentlemen, right here is how you can set up a trade. So right now, if we did this trade live in any broker, if I did a sell stop limit at $18.55 and a buy stop limit at $18.98, I would not be in on this trade. I would sit here and just wait. I would sit here and the stock would do this, and I would not be into any trade at all. I would just relax. And then if that happened, if it rolled over bearish, we would sell the stock short at $18.55. Then we would go in and change this to a stop market, because now that's the price at which I am wrong and I want to get out of the trade. And I could come down here, set up my target. This is the place that I want to make a profit on the trade. And the target would be a stop limit buy. It would be a limit buy. So you just simply do a limit buy order. It's not really more complicated than that. So if you do a market, you'll get out immediately. If you do a limit, you're saying I want to buy at 1777 or lower. So remember, sell high, buy low. That's where I'm wrong. Notice where I'm wrong is about, for even numbers, let's just call it 40 cents. And if I'm right, it's almost $1. So I'm willing to make more than I'm willing to potentially lose. And that's that. There's a lot of interesting nuances in trading. I will agree with you. You know, if you want to just simply buy some shares of something and just hold it until it goes up, that's absolutely fine. But to become more and more of an active trader, you'll notice that there are a lot of interesting nuances. And again, these are one of these nuances, if you will. It's just simply saying, all right, at what price, how do you buy things, that type of thing. And again, if you did this exact order right here, stop market buy order and a sell stop limit, you still would not get triggered in, because this stop market order is still live, boop, if you're not in the trade. And as soon as it hits the $18.98, you have a stop, that's the trigger, and then you have the market, you'll just simply buy it at $18.98. Ladies and gentlemen, any questions who are here live about the order setups in the broker? Now, obviously, depending on the broker, you can have many other ones out there. Most questions I get are these two, MOC and LOC. These are also pretty easy to understand. but MOC stands for market on close. So what do you guys think that means? That means if you're looking at whatever stock for whatever reason at the very, very, very end of the market, like right before the stock closes, you want to get in for whatever reason, you can do an MOC order, market on close. Some brokers have this one, some of them don't. But again, let's just say you're looking at, I don't know, let's just go look at Starbucks. Okay, hopping over to Starbucks, and this is the daily chart on Starbucks. And you see the daily chart, and you see this candle, which is just kind of funny. And you're saying, man, this looks like a pretty slightly bullish candle to me. So at the end of the day, I'm going to buy it. I'm going to do an MOC order. So all you have to do is type in MOC on Starbucks, and you're done. Nothing else you have to do other than click the buy or sell. So you do an MOC Starbucks, and you click the buy button. At the close of the day, I'm talking like literally 20 seconds, 1 second, 8 seconds before the market closes, the order, the exchanges will fill you at the market. Right before it closes, it'll look for a market price and it'll fill you in. Exact opposite with a limit order. A limit order on close is you have to define the price at which you want to buy. So let's say Starbucks right now is at $50.97. You're thinking, man, that's a pretty strong bullish candle. I want to buy it at $51, limit on close. So if Starbucks is below $51 at the tail end of the day, at the close of the day, then I will buy it. And if it's not, I'll leave it alone. So I'm trying to think on a trade that I might still have that order set up. Give me 1 second. Here's one, Pier 1 Imports. So Pier 1 Imports, for example, you can notice at $11.34, I wanted to go bearish. This EOD stands for end of day. So if you said on Pier 1 Imports, okay, I want a limit sell on close. Some brokers have this, some don't. But, you know, if the stock is below 11.34, so right, you do a stop limit. So the stop is 11.34. At 11.34, at the end of the day, if the stock is below 11.34, I want to do a stop limit on close. Again, some brokers have this, some don't. 11.34, 11.34, stop limit on close. At the close of the day, if the stock is below the trigger and it meets your limit of whatever price you want it may or may not fill. So again, it's just entirely about your broker, but usually I just use the time contingencies. I just do a market order. So I say, if I'm using an end of day trigger to make it easy for me, so again, some brokers have this, some don't, but I will say if the market or if whatever stock I'm looking at is below 11.34 after 3:45 in the afternoon, then do whatever it is that I want to do. So if it's an end of day trigger and I'm bearish, I want to either sell the stock short, buy puts, you know, whatever my plan stipulates. Dean said, you can take me off the Starbucks chart. I sold everything at 56. All right, brother. Good job locking some profit. Nice little double top there on Starbucks. So since we're talking about orders, ladies and gentlemen, and there's a lot of you here who are still alive, does anyone have any questions? Any questions at all while we're here about those orders that I mentioned or any other orders specifically? So yes, I agree that sometimes it might take 1 or 2 times watching this video and really just kind of practicing it, but that's really what it is. Practice makes permanent. I can explain it semi-easily because I've been doing it for a long time, but when I first started learning about the market, I had no idea what any of this was nor how to use it or implement it. Brad, do you feel like I covered everything successfully? Did you have any questions? Or do you think I need to clear anything else up regarding stock trades? So I did stop market, stop limit, buy stop limit, sell stop limit, all of the above. Brad says, you want to talk about how to do 2 targets with an OCO order? I could. Realistically, most brokers probably won't be able to do it, but I can. Let me go look at, let's go see if we can try to find a trade. Disney's bouncing. So again, 2 OCO orders, it really is just all dependent on the broker. So Disney kind of looking potentially rollover-ish right about here. So we got like an evening star reversal pattern. So let's just, really quick example. Say that we want to sell short Disney at 96.38. Okay, so this will be a trigger. So we can just say stop, limit, sell, short. What we can just do is, let's just say stop, limit, sell. You guys understand what that means now? So 96.38. So if I said 96.38, I want to sell short. Stop is at 98.36. So here's the stop. Give me 1 second. There's the stop, 98.36. Again, this is dependent, honestly, on what broker you have. Some brokers can do this. Most of them cannot. Just kind of keep that in mind. Some of them can do this, most cannot. So let's say you get triggered into this trade and you want, so let's say we would be in right now at 96.38, meaning we would be bearish. I don't think this is the best trade in the world, but it's a good example. And let's say you have a target at 93.17 and you have a target at 90.36. So this stop, this is how you're going to get out of the trade, right? Because if we're in bearish, we don't want the stock to go up. So we would say stop market at 98.36. And down here in a target, you would have a buy limit at 93.17. And you could do a buy limit for half of your position. So let's say you do a limit sell of 200 shares. Okay, you'd be buying to cover 100 shares here, and you could be buying to cover for 100 shares here. So again, this would be a limit buy of half of your position. All right. So I'm not going to get into this in too much depth because, again, truly it is all about broker capabilities, and very few brokers can do this. But if you set up this trade before it even gets filled, you can do an order triggers to OCO. And what that means is you can set up this order to sell Disney at 96.38. And if that order triggers, then it will set up the OCO of the stop market and then the target at your position. So you can do an order so that your initial order is the stop limit. You can do the trigger to order cancels other. And sometimes, in some brokers, order cancels others. So you can literally have multiple OCOs where you just set up a half your position, target 1, target 2, and you go through the entire chain. It just takes a bit of practice, and it really takes a bit, dependent on your broker, how you can set that up. So yeah, I mean, honestly, the easiest thing to do is if you don't really understand how this works, call your broker and give them an example. Understand that, granted, they may not know the market as well as you do, but they do know the market and they know how it works and things like that. Okay? So what I mean by that is you simply saying, well, if you know how the broker works, you know how everything moves, you call the broker and you say, okay, broker, here's the deal. Jerremy Newsome is talking about in one of his classes at Real Life Trading how to do a stop limit sell at a price and then set that up where I can trigger into that trade. And then if that trade goes through, if that trigger goes through, then I can, at the same time, before the trigger even goes through, I can set a stop and a target. Are we able to do that? Most brokers will say no. And you say, okay. It's up to you if you want to go and find a broker who can do it. You honestly don't have to, because all of this can be done manually. And for the majority of my traders out there, unless you're day trading, this is not really that important to you. Unless you're day trading, the majority of the trades that you take won't and shouldn't be hitting your stop and your target all in the same day. They could, but they don't have to. So it's not really that big of a deal. So let's say, come back over here looking at Tesla, for example. If you had a limit buy this support way down here and the stock gets triggered in, if you're a swing trader, right, you have the ability to just set up an order. You can set up a buy limit or buy stop, whatever you want, and then later go in and set your stops and your targets accordingly. Because once you buy it, usually if you're swing trading, which means you plan on being in the trades longer, if you plan on being in the trade, like if you're swing trading, you're planning on being in those trades for a while, you probably shouldn't be hitting your stop on the same day. Now, granted, it can happen. So if you do swing trade and you get triggered into a trade, that's why if I'm swing trading, the majority of the time I like getting into this trade at the very, very tail end of the day after 3:45 p.m. Eastern Standard Time. So that way, there's only 15 minutes the stock can do something, and usually 99.99999% of the time, in the last 15 minutes of the market, the stock is not going to move so dramatically that it's going to hit or would have hit your stop. So you can just set up your entry at the end of the day for my swing traders, and then go in and then set up an OCO order, good till cancel, for your stop. Let's say your stop on Tesla's here, and your target, let's say your target's up here. Okay, you set up your OCO and you just walk away. That's really about it. So again, that's just broker dependent. If you ever have any questions about market orders, you can always email me. If you have a question about brokers orders, you can email me. I don't know all the brokers out there. I've honestly used, and I do switch brokers pretty often to help out traders and make videos and stuff like that. But at the moment in time, I would simply suggest reaching out to your broker and having them walk you step by step through 4 or 5 examples of how to do something. Because they majority of the time will do it for you. And if they don't, you can always fire them and get another broker. So hopefully this was helpful. Students, especially those for watching on YouTube, maybe watching on Twitter, feel free to subscribe to us on YouTube. Follow me on Twitter, @NewsomeNuggets. You can always email me anytime, Jerremy@reallifetraining.com. You can email Brad @reallifetraining.com if I don't get a chance. I do my best to answer emails within 24 hours. So just kind of keep that in mind. That's my time limit. And I appreciate you guys watching this video. Thanks so much for supporting Real Life Trading. And I hope you have a fantastic day. And remember to love life, live life, and trade it. I'll see you in the next video.